Another voice on the Fed decision. Former Council of Economic Advisors Chair Jason Furman joins us. Jason, so you thought initially that 50 basis points would have been the way to go, but that was before the bank situation. Now you say what the Fed did here makes sense. So how much uncertainty does this situation bring in now that we've gone from a target rate near zero like a year ago to near 5% now? How are those lag effects going to hit over the next few quarters?
I don't know, and the Fed doesn't know. Sometimes the Fed is a cause of the uncertainty. Right now, the Fed is being affected by the uncertainty, just like the rest of us. I thought Chair Powell was admirably clear about that during his press conference today.
Okay, and so what are you watching next for your sense of, hey, what the Fed should do and what kind of economy we're going to have by the time we get to Q4?
Yeah, so two things. One is just the same macro data I was looking at before, things like unemployment rate, job openings, inflation rate, wage growth, but then also financial conditions. And the tricky thing with financial conditions is the market-based measures just aren't that useful right now. What you're worried about is lending standards at banks, and a lot of that is sort of impressionistic rumors and the occasional survey coming out of the Fed to judge those that aspect of financial conditions.
And of course, that's the area where we're focused now, given everything we've seen play out with some of these bank runs and the crisis within that sector. I think it raises the question, and certainly this came up, implied or otherwise, in the press conference today. I mean, has the banking turmoil actually done the Fed's job for it? When will we know that?
I don't know. I think it's probably done part of its job. 3 weeks ago, I thought we should do 50 basis points. The macro data was completely consistent with that. But one of those hikes was done by the banking turmoil, and the other hike was done by the Fed. We're going to have to see over the next couple months how much more work is done by the banking turmoil. Personally, I think there's more upside risk in rates this year. I think the Fed is still being on the optimistic, sanguine side on inflation coming down. I think it's going to be more stubborn. I think it's going to take a lot to bring it down. So I think they're going to need to bring the Fed funds rate up into the mid-5s. But, you know, not at all confident in that view, given just the real uncertainty in the banking sector right now.
Yeah, and I realize that we did get a forecast today that suggests that we could get another 25 basis point hike at the next meeting. But you could also argue on the flip side that Powell kind of opened the door for a pause. It sounds like you think that's less likely.
Look, might there be a pause at the next meeting? I think the market has it at about 50-50. I don't think that's a crazy view. But I'm looking forward 6 months. If 3-4 months from now, inflation is still really stubborn, even if they pause at the next meeting, they're going to have to go back to hikes. I think the most likely scenario, the modal scenario, would have about 3 more hikes this year, unless there's some, real financial disruption that gets worse going forward.
Jason, I don't know if you subscribe to the rule of thumb that these hikes take about a year to have their effect, about a 1-year lag effect. But if that's the case, it sort of makes sense that SVB happened about a year from when the hike started. And then we had those 75 basis point hikes in a row. Does that mean we're going to start feeling those over the next few months? And if so, I mean, does that make it even harder to gauge what the next couple quarters are going to look like?
Look, I think the pass-through for monetary policy is a little bit faster than that, especially if you're looking at growth rates. It takes a while for the full level effect to play out, but the growth rate effect is a bit earlier than that. But yeah, Silicon Valley Bank delayed that timetable. They say long and variable lags for a reason. Silicon Valley Bank is a variable part. Do I think another shoe will drop? I don't think so. I think they have this contained with the financial tools they have. Rates have been, long rates have been high for a while and have eased off some since Silicon Valley Bank. But you never know what pools of leverage are out there and will make themselves known.